Howdy, everyone. This is your skipper here, Darius Dell, to present our macro bundle Q&A for Wednesday, November 17th, 2021. I'm joined by the wonderful Nadine Terman of Solstein Capital. How you doing today, Nadine?
Good, but I just want to say congratulations. So exciting, the news from last weekend. So really happy for you.
Yeah, I'm lucky someone I found someone to love me back. It's a wonderful feeling. I'm feeling very blessed this past few days. So thank you for that. I wish asset markets in 2H21 were as easy as falling in love as is. They certainly aren't. We got a lot of we got a lot of cross currents continuing to shock investors. I've been making the horrifically played out joke now for the past couple months about the Hanson brothers relative to the Jackson Five, and quite frankly, I think the joke was quite prescient. We have not seen a rip roaring, full fledged kind of 1H21 style reflation trade this fall and into the early part of the winter. And we ultimately continue to think that we're going to see some bullish resolution asset markets into and through year end. However, the composition of the dispersion and what's leading the market and lagging from an asset class perspective is clearly changing, and it certainly doesn't look like what it looked like in the first half of this year. So, any thoughts on that? Kind of, how do you see things sort of kind of evolving your client portfolios?
I mean, it seems like, one of my clients wrote us yesterday and thanks for what you're doing. It seems like you're riding the bull, right? Because one day energy's up, then the next week it's down, then it's up a lot. You got, gas down, then it rips. And so I think that the key thing is you obviously have to have a process, be data driven, and be watching these signals to say, like, you think you're in a reflationary environment, but what's actually working? And then obviously you're not going to be trading in and out of every single security every day. But when you're seeing trends that are either confirming or disconfirming, deciding to make a move. So I think that you have to be a little bit more tactical, be watching things more carefully. But then again, obviously we're staying invested, and that's been the right approach. So it's definitely not for the faint of heart.
And this is why, part of the reason why I built this CACRI model, right? It's designed to help investors sort of ride the bull. More importantly, it's designed to help investors identify opportunities to get bullish, after a market event. It's nothing you see on any slides in this deck. And again, there's 150 slides in this presentation. Nothing on any one slide is going to be perfectly aligned with helping you get in or out of the market, or in or out of the right sectors and style factors. But when you sort of piece together all the component parts of the process, you're going to do a lot better than you would in the absence of those parts. So, this is something I've been writing about for quite a while now. So, the last time CACRI was in the complacency zone was in the early part of June. And if you go back and look at just sort of like the bottom up macro regime perspective, CACRI should have been complacent
Yeah.
in that time frame. You tend to get complacent asset markets when growth and inflation are accelerating simultaneously, as we obviously saw in June. But one thing that sort of kept, in our opinion, kept the market well bid, into and through, since that point, was very clearly an emergence of a decelerating growth environment. Was the fact that we have not seen a real complacent market yet in terms
Right.
of investor consensus positioning and things of that nature. So we continue to call that out. I ultimately think we'll get CACRI into the danger zone. Right now, it's at 41%. We'll get it into the danger zone, and more importantly, we'll have it poke its head out of the danger zone into a scenario that's clearly not, favorable for taking
Right.
risk and speculating on risk. And so, to me, I think that's the big kind of play by play, if you will, over the next few months to be aware of in terms of kind of finally parking and booking some gains on what has been an obviously pretty ferocious bull market, if you will.
Yeah, and it's funny because yesterday in an interview, I think it's going to be posted today for Wealthy on, and they, I guess, were asking, can you find somebody who's been long and bullish in the market? Because I think he's been doing interviews with everybody who's really bearish,
Uh,
and he's it's like, how he named a million things of the why you shouldn't be invested in this market, and he's like, why are you invested? Why are you bullish? I was like, let's just look where everybody's positioned. Let's look at implied volatility premiums. And
mhm.
one of the key arguments, which I think is, really telling of where a lot of the value investors and wealth managers sit, is they look at multiples and they're like, oh, this, if you look at a multiple versus, PEs or price to book, gosh, it's so high. And I was like, well, let's just talk about, well, where it might be high And is that really the right metrics you should be looking at to decide, what to do? And look at European financials, and they don't have the multiples you're talking about. So there's always pockets that you can find to go long in. But then let's to, like, can somebody here in the chat tell me, like, why they're going to value a REIT as, like, 5 times free cash flow, or 5.5, or 6, or 6.5? Like, that's extremely arbitrary. So and so I said, let's take a look at where everyone's positioned on the things that you're talking about. Like, coming into the week, they were like short the Russell. Coming in the week, they were short gas. Look at the premium, so people are paying for protection. I said, aren't you playing against somebody? If you don't really look at your competitor, then, what are you doing? You would never go onto a basketball court or on a soccer field and not know the strength and weaknesses of who you're playing against. So you shouldn't be doing that here either, right?
I say this all the time. I mean, valuation is just not a catalyst, particularly on a duration that is more aligned with risk management.
Yeah,
Valuation on a longer term time horizon is absolutely a very important metric to use if you're, longer term investor making
yeah.
strategic bets. But if you're talking about compounding returns across cycles, not strategic cycles, then you need to sort of put valuation kind of back in the war chest and use more prominent tools like growth, like the rate of change of growth, the rate of change of inflation, the reaction function to those functions therein with respect to policymakers. Those are all much bigger drivers.
For a second, Darius, there's a question from Cannon, and it kind of dovetails into this. He's saying, CPI projections for the first quarter of 22,
Yep.
in the morning note are now for an acceleration. And George is talking about, when something goes bullish trend, should it be immediately bought? Should we wait for the next dip? He missed out a lot on returns the past month because there was no dip in these type of reflationary assets that might have done well. So I kind of put these two things together, even if one didn't mention inflation. But let's talk a little bit about what you think about inflation and what does that do to risk assets.
I'll clarify that we actually don't have an acceleration posted for inflation right now. Our model is calling for October to be the high print of the cycle. Obviously, it's not going to decelerate. It's not going to get to a level that makes you feel comfortable about the inflation dynamics for quite a while. But the reality is, we do believe we're at the peak of the inflation cycle. Whether it's October or November, we will see. There could be some near term
Sure.
forecast there. But I think the real key takeaway is it is always whenever you're at the peaks of these cycles. We all know what to do as investors when we're at the peak of these sine curves for this is inflation. Obviously, you certainly know what to do when you're at the peak of the sine curve for growth. And for whatever reason, we always every single time we get to a new sine curve, there's a different discussion.
Yeah.
But there should not be a
Yeah.
different discussion. We know exactly what to do when we got here in the latter part of 18. We know exactly what to do when we're here in the latter part of 2021. It's no different than kind of latter part of 2015. It was no different than the latter part of 2007. It's all the same with respect to using the sine curve to guide your investment process in terms of betting on exposures, both sector style factors within the market, but also asset classes, allowing it to guide your exposures appropriately for the future, not for this way. You don't invest looking back. Obviously, we all know inflation is 6%, but where is inflation going to be 6 months from now? We actually have accurate, reasonably accurate models to help you get to that answer. Right now,
Can
we're
you
in
can you
October.
explain something for people? Can we stay on that chart for a second? We have Kaloyan here, and he says, can you do a deeper dive in the differences of using trending, so year over year, sequential, quarter to quarter? If he
Mhm.
understands correctly, the bottom-up macro process pays attention to the sequential of the trending quarter rate change of the 2-year average of year over year data. So maybe, just for people watching, if they're less familiar, and obviously you can comment on what he's saying here, but when do you care about the rate of change? So what's the base level that you're going from? Why do you choose that? And then if you look quarter over quarter, what does that matter to you versus looking at a year or two ago?
Yeah, so I think the short answer is we care about the year over year deltas, particularly for something like CPI. We look at the deltas for the OECD Composite Leading Index time series to amalgamate our growth forecast. But the reality is that that tends to correlate with the year over year GDP statistics much better than it actually correlates with the sequential, the quarter over quarter statistics as well. So what we're really trying to do is help investors identify the trending rate of change of the year over year time series, whether it be for something like growth, which again is being amalgamated by this particular time series on a monthly basis, or if it's something like inflation, which obviously is just getting reported by the BLS or by the Census Bureau, or whatever government agency abroad. And so, the reality is in COVID, we've all known, going, this is something I've been talking about for a while now. It's actually just analyzing a lot of economic statistics on a sequential basis. It's down here looking at the SARS, the seasonally adjusted annualized rate of change for a lot of economic statistics, because we know we're going to have, very easy base effects perpetuate very high levels of inflation and high levels of growth throughout 2021. But the reality is the impulses have been very instructive in terms of dictating sector and style factor leadership in markets, because I think the average investor kind of gets the joke on the year over year for now.
Yeah.
Eventually this kind of, very, this obvious dynamic will stop. We'll start to go towards more trend growth and inflation rates once we get to the second half of next year, which will put the kind of the onus in terms of interpreting data back
Right.
on the year over year. But I think
Right. And
until we
mapping
see
versus guessing, like, well, it's bigger than last year, right? It's like
yeah,
anybody can guess that. But
exactly.
if you don't have a process in the data, then you're going to be a little like, I guess, less on the mark.
Model is being shocked by things that are very non-cyclical, non-recurring. Record fiscal stimulus, where we're talking about record fiscal stimulus, reopening demand associated with vaccines. Those things are very much non-recurring. But if you're talking about building a model that is anchoring on base effects, that is anchoring on seasonally adjusted momentum in the historical time series, in the stationary time series, then you're talking about potentially training a model to assume that this kind of behavior is normal. And the
Yeah.
reality
Right.
is what we're actually looking for is saying, hey, no, that kind of behavior is actually not normal. When does it start to go back towards normal?
Yeah.
Is why I've
Yeah.
been looking at it like that, because this will be late to the party. The year over year statistics will be late in terms of telling you that.
And so maybe we can just jump it a little bit. There's Jennings has a question, and it gets off the sequential, and also the annual rate of change. But what's your biggest takeaway in terms of investor consensus in regard to the 10% jump in the conviction score perspective on inflation deflation? It matches one of my things. All I wrote was R arrow I/D. So that's my, note to myself that your data is showing that some of reflation's probability has been eaten up in the future by inflation and deflation. And obviously that matters from a timing perspective to shift portfolios. So maybe you can talk about, Jennings' questions about what's the biggest takeaway from that.
Yeah, that's a phenomenal question, Jennings. Thanks for joining us. We appreciate you. So I'll start by saying, maybe a week and a half ago, 2 weeks ago, certainly prior to this October CPI print, I would have thought we'd do something like this: R to G to D in market regime terms. I
Yeah.
think the inflation print almost, I mean, certainly in conditional
Yeah. Took it
probability
away.
terms with respect to the economy, it basically made Goldilocks a very low probability event from an economic standpoint. So the probability that we actually realize Goldilocks in the market regime nowcasting process was actually much lower in my estimation. And so going back to this slide, what's actually happening now is that the market is effectively saying R to maybe I to D.
Yeah.
And that's
Yeah.
kind of what's happening in terms of what's occurred with respect to what's changed in the global macro risk matrix over the past few days, and that's driving the conviction score higher, right? The conviction score now is elevated. It's not ever going to get to an elevated level if we stay with a lot of dispersion. What gets it to an
Yeah.
elevated level is when Goldilocks and reflation have a bunch of points, or in deflation and inflation have a bunch of points. Those are
Right.
risk on versus the risk off regimes. And so we're going to hodl at this level of conviction, this kind of middling level of conviction for a while until and again, I think the probability of going into a full-fledged reflation regime is declining rapidly. It's going to hodl at this sort of middling level until the market really starts to price in I and or D.
Yeah.
One thing, if you guys have noticed this morning in the table, in the bottom up macro regime summary table in the lead off morning note, I added these two columns.
Yeah.
I think these columns would be super instructive for a lot of investors, trend-based investors, which I would consider ourselves in that category. You start to look at the next 3 months and the next 6 months, and like if you're sitting here today, looking
Yeah.
out 3 months from now, the probability of realizing stagflation in the economy is actually quite high. And if you're looking 6 months from now, the probability of realizing deflation in the economy is actually very high. And so, as an investor, you have to be aware of that in terms of what do you do with your incremental dollar of capital. When you sell
Yeah.
something, when you book a gain, are you
Yeah.
going back to buy, I don't know, base metals or something like that, something we sold last week? Or you're going to actually start to rotate into things that agree with the forward outlook. And obviously, what our take is on that with respect to
Well,
both.
and maybe talk about that, right? Because that was a big shift that you brought out in the past week, right? It's kind of
Yeah.
taking off the base metals, adding on some deflation. But at the same time, you said, hey, the investors are overbought on some of this deflation exposure. So be patient. So I think that, one of the questions that, is probably behind Jennings' question there is a little bit then like, what do you do as an investor, right? And so how do you navigate this sign that like, okay, people might have been short treasuries or, people, the signs aren't right yet to be going to full deflation. So, and also in your statistics and note, it's like, it's too soon to make this call and be shifting, full fledged. So, what is the type of data, that people should be looking at in your statistics and overall to be able to get a sense of making that shift? Because as you know, like, even though you might print something in a day, like shifting a whole portfolio is not going to happen a day for, especially if someone's got a taxable account or something. So that might be like a bit of an interesting question on more execution relative to your process.
Yeah, great, phenomenal question again. And so, in terms of the answer, I was actually on a client call yesterday talking about this. Over the next 3 months, this pie is going to migrate here. I don't know what day or what signal or what set
Yeah.
of signals is going to catalyze that. I would imagine it's going to come in tranches. I mean, that's the general rule of thumb is not make too many wholesale changes all at once, but it's likely to come in tranches over the next few months in terms of reallocating the reflation exposure back into deflation. And the reason for that is I think, you know, whether we actually observe the post delta bounce and realize data terms is still out the door. I think we obviously saw a lot of different confirmation of that in yesterday's industrial production, retail sales data, inventories data as well. But the reality is, I do believe when you talk about, kind of what could actually accelerate that process, to me, it's not about how long can I wait and, is this going to be like a March 2021, 2022 event? I can just hodl this and kind of, not get paid on that for a while. Obviously, if I thought we weren't going to get paid on this for a while, I wouldn't make that bet. To me, the reason why I feel a little bit more confident in kind of, incrementally allocating towards deflation, i.e., we added BNDD, we added zeros, is because I think we're running the backup in bond yields is running long on the tooth.
Yeah.
One, partially because we have inflation peaking in October. That's the obvious point. But even if it's, peaks in November, we're wrong on that, by a couple basis points. Who cares? The reality is, by the time you get into what I would argue is the first live month, from the perspective of the Fed deliberating whether or not to accelerate tapering or not, which I think is January. They kind of put the November, December 15 billion on the tape already. When you get into January, you're still going to be talking about inflation in terms of the December data with a very elevated print, like a high five print. I mean, the high five print is plenty of data or plenty of plenty enough inflation rather to get the Fed to say, hey, maybe 15 billion a month is the right number. Maybe it's 20 billion a month. And in our opinion, that is very bond bullish. As we've seen time and time again. I mean, every single time we go through these cycles, there's a whole collection of investors that have seemingly forgotten the last, what QE, what tapering and the removal of QE does to bond yields. And this is because of, I talked about this a couple of months ago. It's because the Fed is comically pro-cyclical with their policy. Now, this Fed is a little bit less pro-cyclical, but they still tend to be pro-cyclical, and that's exactly what the market's pricing in with respect to the pull forward of interest rate hikes in the Eurodollars curve into 2022.
But I mean, I'm going to push there for a second because, at the same time, so let's say inflation's, reading hot in January, but, COVID is up, just like, Ireland's now, one of the most highly vaccinated countries, and they're putting some restrictions on. We've seen more restrictions in the Eurozone going on, exactly Germany and Austria and others. Like, does the Fed actually make that call when there could be signs this winter, just we're seeing in the Northeast, the numbers are going up, when they might be seeing, lockdown concerns or COVID concerns? We saw what happened in September, because then it's more of a stagflation event, not a deflation event. And does that kind of box them in versus then, so when you're might be hitting that demand curve, does it actually change that? And do they kind of stay on course with the tapering? versus, increase the tapering because of that issue. That's the other thing I'm trying to think of, what could change that narrative. And that's one thing I think about.
Yeah, I think COVID is still much of a very major factor here. I don't know that we're on a preset course to realizing an acceleration in tapering. All I'm saying is that I think the probability of investors sort of whatever the market implied probability of accelerating tapering is now is likely to
Go up.
increase over the next
Got
couple
it.
of months.
Got it.
As a function of the data, the inflation data, going back to the inflation sine curve,
Yeah.
not coming down as fast as it needs to be to avoid that discussion. They're going to walk into the January FOMC meeting and have a discussion about accelerating tapering. And it's
Yeah.
because, this inflation sine curve is still be here. We'll still be in no man's land in inflation with respect to the last 30, 40 years of data. And so
Yeah.
that to me is a potential market risk. Not only, it's less, in my opinion, a market risk until the actual net liquidity dynamics inflect. But I do believe it's a risk up to the upside for bonds and to the downside for bond yields. Because again, what this all effectively means is we're coming to a head at the peak of the inflation cycle. And if you look forward, as bond investors tend to do, with a little bit more acuity and a little bit more consistency than equity investors,
Yeah.
they could get the joke. I think everyone
Yeah.
gets the
Right.
joke. I mean, I looked at our core PCE forecast for, because part of our, in terms of how our models actually work, there's two models working simultaneously. You can certainly see the divergence here. The dotted blue line is our stationary mean reversion model. We're just modeling headline CP on a stochastic basis. And then we're actually looking at the agent-based nowcast model and projecting each of those nowcast features forward. And so what you're starting to see is that, hey, look, if you kind of peel back the onion on something like core PCE, which is in the inflation nowcast model, we're talking about core PCE around 2.7% by the time the Fed gets into July.
Yeah.
Into July, which is, in our opinion, the first live meeting on rate hikes. That's right in line with what they have it at the end of the year, 2.4% at the end of 23, 2.3% at the end of 24. I think this chart is wrong, quite frankly. I mean, I don't like to say that the markets are wrong, but this chart is giving you an opportunity as an investor to put on a fantastic receiver trader for those of you who are the macro fund managers and things like that. We don't think we don't think the short to belly end of the curve is ready to buy at this particular juncture, but certainly from the perspective of the longer long end of the curve, I mean, this is a very obvious chart. I mean, it's less obvious on the 10-year, but the 30-year is telling you it peaked in the early part of this year, made a lower high, and we potentially could be making a lower high here. And that, in our opinion, going back to one of the things we mentioned at the beginning of the slide, and I'll shut up on this, is why we continue to expect to see a little bit more defensive, incrementally defensive tilt to sector and style factor leadership from here through the peak of the ultimate bull market. And as I've been saying, that is not pure reflation. This would be something more akin to inflation or stagflation.
Right. So let me head over to volatility. So Jennings has another question about the VXX. And so do you have any insight into the VXX short squeeze that's been happening, and what does that suggest to you?
On a 3-month forward basis. And so obviously you're talking about the puts on the VXX being extremely elevated, and these are at the money puts, so it's pretty much the same. But you look at the y-axis, that's the volatility risk premium in terms of how we calculate it, looking at 30-day at the money put implied vol relative to the mean of 10, 20, and 30-day realized volatility. And so VXX, what this is effectively showing is the market is very, it really believes that put implied vol is going to go high. And what I've shown, I don't have this chart in the deck, but what I've shown in the lead-off morning note the past couple of weeks is that, hey, the VXX is actually positively correlated to its put implied volatility in spikes. And so what this is effectively saying is that the market is actually betting on a VIX spike.
Right.
In the so much that it's betting on, U.S. equities, these are all the reflation equities. You got the SPY up here, the RSP OEF up there, in so much that it's betting on a pretty big, near-term pullback in the stock market. To me, those are signals to be faded. And again, I talk about this all the time. Markets don't crash when everybody is hedged and positioned for a crash. They crash when everyone, when the VXX is down here and SPY's down here, and everyone's saying hallelujah, high five, and backslapping each other. That's just not the setup we have right now. And ironically, that is what keeps the market grinding higher. The fact that everybody is bearish is the reason the market continues to grind higher, because you have all the the options market dynamics and the dealer flows associated with those dynamics that continue to perpetuate a gravitation, if you will, of the equity market.
And just on a single security question here from Alvaro, is that can you discuss why the AMLP was taken out of the portfolio, given that it backtests positively with inflation and stagflation? Maybe walk him through that.
Hey, sorry, we lost Nadine. My apologies for that. Apologies for the technical difficulties. We'll get those cleaned up as we figure this out over the in the coming weeks. But sort of piggybacking on what Nadine said with respect to, does it play? Does it do its job? You go back into something I've been talking about, for a while now, with respect to all of our commodity exposure. You look at the Bloomberg Dollar Index that's been bullish. VAMs for a few months now, with respect to our volatility, just a momentum signal process. And as I mentioned, that's probably word about this a few months ago, which is most of the commodities in our global macro risk matrix, the volatility adjustment for those commodities is the Bloomberg Dollar Index, not its own realized volatility, not its own implied volatility index, although for crude oil, that tends to be the case. But for the most commodities, the dollar is sending a signal that, hey, look, the probability of having a drawdown is higher than it otherwise would be if you were bullish. And this is certainly the case for nat gas, certainly the case for uranium, certainly the case for a lot of the things that we had in the portfolio construction. And so, in terms of why you would sell something like a AMLP, for instance, it's, hey, look, it's not the most favorable environment to be taking that kind of risk anyway. Again, we put all those positions on going back to September and early part of October. It's saying, hey, I think the probability of realizing inflation or stagflation, as many of you would call it, in macro regime terms in the economy is actually quite high. And so we want to be hedged for that outcome in terms of, not necessarily realizing this wonderful Jackson 5 style reflation trade where you're betting on, the most illiquid small cap, kind of, minor, those types of exposures. We didn't get that. And I think, as we go forward in time, as we get, further and further to the other side of the peak of the inflation sine curve, we think one by one, you're going to start to lose a lot of commodity speculation as a function, one, of the strong dollar, but two, as also a function of, what could potentially be a derailed Biden economic agenda. We'll get more information on that by the end of the week. But I continue to believe, I'm of the view that 175, 185 is what we're talking about now might not be the right number. It might be 1.5 or 1.25. We don't know what the right number is yet, because I do believe these inflation dynamics are certainly taking the wind out of the sails in terms of the marketing and the messaging around that.
Get to George's question, George from Syracuse. I'm going to guess that's where he's from, or that is his last name. But to go to CACRI. So when should we expect the CACRI to signal silly season? When fourth quarter results are known, sell the news, operating with one foot out the door. We'll be using the dial or dimmer method to not get caught off guard. So I think he's trying to say when we get in the red zone, should be, preempting that red zone signal. What do you think about that?
Yeah, I mean, look, we're still in a favorable environment for risk taking. Net liquidity continues to be quite positive, as we talked about earlier. And so, at some point, I would expect, particularly with respect to equities, I'm more concerned about, the commodity speculation and the
Yeah.
volatility of that asset class that could develop in terms of not realizing some of the consensus narratives out there. But I would expect, into year end and into the early part of next year, you could in fact get that kind of last gas push higher. We've seen this movie play out many times before. I mean, this is, we've seen realized vol collapse in late
Yeah.
2017, catalyze a big bull run in stocks. We saw realized vol collapse in late 2019, catalyze a big bull run in stocks. And I think this is a sign of something we're talking about now. Again, when I put when I put this chart in the October scouting report, I said, hey, it's October. We're going to lose the September and October corrections from 2020 out of the time series, and we're going to have a collapse in realized vol. And guess what that collapse in realized vol is going to do? It's going to force a lot of vol targeting funds, CTAs, incrementally into equity markets. And certainly, as we continue to make lows on these types of metrics, I do believe that's likely to continue to push incremental funds into the markets. So as it relates to CACRI, I'm not sure when that peaks, but as we saw, this was early February, mid-February 2020. We saw this was mid-January of 2018, and so it's kind of I wouldn't say my expectation on that, but I certainly believe that's a good playbook, a rough playbook to follow.
We have another question about specific securities. So talking about healthcare, so XLV and the utilities XLU. So the question is, should we be scaling into those into the phase transition um, now versus waiting for those?
So we've obviously just bought XL or Pink. We use Pink, the Mike T Simplify ETF, but what we're really doing is just looking for healthcare exposure. And one of
Yeah,
the reasons we're looking for healthcare exposures, we're now getting into the point of the process where I don't think it makes any sense to go buy something that only works in reflation, right? We're still in a
yeah,
reflation market regime, and the markets, generally will trade like reflation until then. Although I would argue we've already kind of, from an internals perspective, switched over to this one. I don't want to go buy something that's only going to work in reflation, knowing that this is probably where we're headed, and
yeah,
certainly D is probably likely to follow after that. And so the SPHB with high beta would be a great example of that. With something like healthcare, if I'm putting incremental capital work, and this is what I said going back to slide 12. Hey, when you look forward in the next 3 months, the modal outcome is inflation, and in the next 6 months is deflation. And so going back to those back tests, it's like, look, I'm going to start picking things from this side of the chart.
yeah.
Like, ostensibly I positioned for this in September when we pivoted to grid zero. We added
Yeah.
a lot of stuff that took advantage of reflation, particularly on the commodity front.
So maybe run
I just
through
don't think
those for
that's the
people. So you've got healthcare, and obviously you didn't pick the XLV, but you picked another one. But maybe run through what those positions are, because people might be interested for a kind of a rough list.
and then sometimes I'll put them in the round the horn. We're making portfolio construction changes. When you draw on a line here, ideally all of your longs are coming from the top left of the chart, and all your shorts are coming from the bottom right of the chart. Or at least when you think about kind of pushing them through any sort of technical process. Obviously, we
Yeah,
have our own here 42 macro, but everyone's got their own technical process that they adhere to. The reality is this is telling you high on the y-axis is a high potential reward, and low on the x-axis is a low potential risk. So you're getting a good bang for your buck in terms of those types of exposures with respect to the economic environment. The
yeah,
economic environment in terms of how these back tests work. We're programming in stagflation in. We're saying, hey, growth's not going to slow that fast yet, although I do believe the deceleration in growth in the latter part of Q1 is going to be a problem for asset markets. But we're not there yet, obviously. Inflation obviously is moving pretty high to the upside on the 1 sigma delta. You got easing out of the Fed still. You got tightening out of the fiscal policy. You're going
yeah,
to have that. And then the rest of the world in stagflation. So when I
yeah,
program those back tests into the blended returns, the blended regime rankings, and doing this again across annualized expected returns, percent positive ratios, volatility, and covariance, this is how it shakes out visually. And so I
yeah.
think it's a much simpler way to kind of think about, your long versus your shopping list on the long side
Yeah.
versus short side relative to some, more archaic process.
And so maybe stick on that, because there's a follow-up question on that. Is that in the last week's Around the Horn, you mentioned define assets that look good in both, I and R. And the risk reward looks tasty for the utilities, XLU, although it's not typically, long in reflation. So how do you reconcile that type of reading?
Yeah, and so I mean, it just doesn't look XOU does not look good in INR.
Yeah, that's what I
I
was
mean, I
going to
would
say,
argue
because you actually
it's a
said go
below
long
median.
staples, short utilities, right?
Yeah. Oh, yeah, yeah,
Yeah.
exactly. Well, that was a tactical trade
Oh,
based
yeah.
on the volatility risk premium analysis that we were doing the other day.
Yeah.
So you had both XL, you had XLP up here and
Yeah.
XLU down here. So anytime you're on the same plane as something, obviously you want to go buy the thing
Yeah.
with the
Yeah. Yeah.
higher
Yeah.
eyeball premium. And so, but just going back to the back test, XLU is a below median return relative to this entire sample. So I would not think that that's a great place to play
Right.
in reflation. Certainly it is a great place to be in inflation, although I'm not entirely convinced that the market is fully pivoted to that yet. Clearly it's not even entirely convinced. We know the market hasn't
Yeah.
pivoted to that. Going
Yeah.
back to our now process, maybe it's on its way to pivoting to that because we're seeing that in the dispersion analysis. And more importantly, and I think we can kind of end on this, this is uh, this is new. So this neutral signal is I've been saying for a while now. Hey, look, it's an obvious risk on signal you're getting from the high beta low
Yeah.
beta ratio, and part of the reason for that is that when this thing is bullish, it's telling you that the price momentum and the medium term price momentum in high yield OAS is bearish. Well, now that it's neutral, it's telling you that there's something going on in high yield OAS that you need to be aware of. And guess what that
Yeah.
thing is? It's a bullish Vans breakout. Now we've seen a bullish Vans breakout in the middle part of the summer, so it's, I'm not overly concerned about it in terms of the net liquidity provision, but it's certainly something that's telling you that, hey, look, this market is not pricing in reflation anymore.
Yeah.
I mean, like it's technically still a reflation market regime, but like in terms of like this being neutral, this
Yeah.
being neutral as well, small caps, mega caps ratio, it's not pricing in inflation because obviously neutral doesn't mean inflation
Yeah.
either. It's just telling you that the market is confused. And more importantly, if you're confused right now, the only way to get out of that confusion from a resolution standpoint is to look forward into the future and say, how
Yeah.
is this going to get it resolved?
Right.
Is it probable that small caps break out relative to mega caps based on our forward outlook? No, the answer is obviously no. Is it probable that I beta breaks back out to low beta based on our forward outlook? Probably not. And certainly value to growth, which is making new lows, is
Right.
very much clearly telling you with this bearish VAM signal that the forward outlook for growth is actually not quite positive. So I think that's kind of the way to shape it up. It's summarize. I know we went through a lot of information today. If I can summarize this, it's you have more time to take advantage of the equity bull market. I do believe commodities will remain in a bull market, but I don't know that you're going to see the kind of breadth that we saw, coming out of the August lows for a lot of things like, energy and things of that nature. So I don't want to be the one holding the bag on that in portfolio construction terms, particularly heading into a potential fiscal policy disappointment with respect to the size of the Biden administration's agenda. You might also see, again, I don't know that we're going to see, but I think the probability will rise that the Fed will have a serious entertain a serious debate about accelerating tapering in a couple of months. Then in our opinion, that could actually be quite positive for bonds because what you're talking about, that reduction in liquidity has historically been positive for bonds, negative for risk. And so that's something that's on the horizon as well. So between now and then, it's like, just use the tools, use CACRI to, maintain that proper exposure to the market, use the portfolio construction. And more importantly, I think hopefully everyone's kind of getting what we're doing here with the portfolio construction in terms of the pies rotating.
Yeah.
I think this part of the process is really helpful. If you're not going to follow along with this, because obviously not everyone's going to do this, but just understand how and why the size of these pies are changing and when they're changing is super instructive in terms of you guys all following along and managing your own assets.
Darius, can I get in the one last question? I think it's a good question. You have some good questions in the queue, maybe answer for people offline. But Stead has a question
Sure,
about the
yeah, keep
dollar.
going.
And it's like this strength seems to be more of a function of euro weakness as opposed to pure dollar strength. Hence, we're seeing commodities, gold, Australian dollar, Canadian dollar holding up. What are your thoughts? He's asking a little bit more of why versus what happened because he knows what happened. But maybe talk a little bit about the dollar strength. And obviously, in deflation, dollar does well. And so, why is it happening now? Do we know? And how do we navigate this situation when the dollar usually is not strong in reflationary environments? The dollar is not strong in inflationary environments. The one time the dollar is strong is deflationary environments. So how do we thread this needle on what's going on?
Yeah, so I think the first way to thread the needle is that, hey, look, we've been in this period of limited dispersion amongst the four grid regimes from a market regime notcasting process, and we're actually heading. It looks like we might be heading back to a period of limited dispersion. And what that means is that you're not getting full buy-in from all these
Yeah.
markets on one regime or another. Like it's and I'll put not push back. I'll add to the kind of the premise of the question, which is saying, hey, look, don't expect every single market every single day to agree with each other. That's not
Right.
how macro works. I mean, it's a misnomer in of itself. The whole point of asking 42 different markets is because at various points of the cycle and in various cycles, you're going to have things break out and break down before other things. There is no sort of kind of like a perfect sequential process. So like this one goes first and that one goes first, and then this one follows that one and that one follows this one. The reality is, I've studied this table, very intensively. It's like, look, back when COVID-19 hit, it was like the Mexican peso was the last thing to flip the thing in the deflation. But like it could be like the triple C credit spreads in Europe could be the thing that flips the thing in a stagflation or anything like that. We don't know. The reality is we're using math and we're using tools to help us sort of gauge all these changes in real time in a way that it'd be obviously really hard to do, with just your naked eye. And so that's the whole point of this process is to help you get the signals from the market that you need to get in real time, as opposed to having to wait for the economic data, or more importantly, having to wait for the things that you're long in your portfolio to change. We want
Yeah.
to use the changes in the macro market environment to front run those actual P&L changes in our portfolios. And
Well,
so,
thank you.
sorry to answer the question on the dollar specifically. Yeah, of course. To answer the question on the dollar specifically. So, for one, the Bloomberg Dollar Index is not overweight the euro to the same degree that the dollar DXY is. The DXY is around 57, 58%. I want to say it's around 30, 35% for the BBDXY. So it's not just a euro breakout. And oh, by the way, this thing's been grinding higher since we put it on in June. I mean, I put it on as a deflation hedge in June, and it's done nothing but go up since then. And so it's telling you that, hey, look, this concept of liquidity bottomed out. It certainly bottomed out when reflation peaked out in the early part of June. This is, very clearly, this is one of the most historic reflation trades we had ever seen at the 99th percentile conviction score at the peak of that reflation trade. Obviously, a lower high here is telling you that this is not that trade. I've been saying that the entire time. We're going to get a mini reflation trade, and I was very specific about it being mini at the time when we made that call. So in terms of the dollar, we can't expect the dollar to be selling off towards the dollar here. Sorry, can't expect the dollar to be doing this like it's a full blown,
Right.
early 2021 inflation trade.
Inflationary
I
trade,
think what the
right.
dollar is actually telling you is where we started this conversation, which is
We're going to
the
D.
currency market and the bond market are looking forward into the next 3 and 6 months. And they're not trying to take advantage of a year-end beta chase in equity market.
Yeah.
They're not trying to take advantage of a shorter term kind of trade with respect to the fiscal policy catalysts and things like that. The currency and bond market are actually looking forward into next year and saying, hey, it's going to be a way different environment and rate of change terms. So get ready for that.
Awesome. Thank you so much, Darius.
Yeah, absolutely. No, thank you, Nadine, and thank you guys all for participating. These are fantastic questions. So
Yeah, they're great questions.
obviously the subscriber base is high grading before us in our very eyes. I've been challenging myself to explain things more clearly. I was actually about to use a word, and Larry actually told me to stop using big words, and that was a great piece of advice. But this is there's a lot of information that we're producing on a regular basis, and I think we all need to sort of take time to actually educate ourselves, including myself, on the process, how it works, and ultimately how it's driving the decision makings that I'm making, that you guys are making alongside me, your respective portfolios. And the number one thing I'll say about that is I certainly appreciate you guys tuning in. Thank you.